You already know enough. That is not your problem. I want you to sit with that for a moment. Because if you are watching this, you have probably spent months, maybe years, studying charts, reading books, watching videos, buying courses, testing strategies. You have done the work. You have put in the hours. And yet here you are. The account is down, or it is gone entirely. And somewhere in the back of your mind, a quiet voice keeps whispering that maybe you just need one more piece of information, one more setup, one more edge, and then it will click. That belief is the problem, not the market, not bad luck, not the brokers, not the spreads, not the fact that institutions are hunting your stops. The belief that more knowledge is what stands between you and consistency, that is what is keeping you stuck. I have spoken to hundreds of traders over the years. Talented people, intelligent people, people who could explain market structure, probability, risk-reward, all of it, with precision. And they were still blowing their accounts, over and over again. Because the gap was never in what they knew. The gap was in how they thought. I have spent the better part of my life studying one question: why do intelligent, hardworking people keep self-destructing in the markets not once, not twice, repeatedly, in the same way, with the same result? And what I found, what I know with certainty, is that the answer has almost nothing to do with strategy. In this video, I am going to show you the exact psychological cycle that is destroying your account. I am going to show you what it looks like from the inside, why your own mind is working against you, and, most importantly, what it actually takes to break that cycle permanently. Not with a new strategy, not with better indicators, with a fundamental shift in the way you understand what trading is. Here is the truth that most people in this industry will not tell you. Your brain was not built for trading. It was built for survival. And those two things are almost completely at odds with each other. Think about what survival required for most of human history. It required you to avoid loss at almost any cost. Losing food, losing shelter, losing standing in the group, these were not inconveniences. They were threats to your existence. So your brain developed a very powerful bias. Losses feel approximately twice as painful as equivalent gains feel good. This is not a theory. This is documented, observable, consistent across cultures and populations. Researchers call it loss aversion. I call it the enemy of every trader who has not yet learned to work around it. When you are in a losing trade, your brain is not processing financial information. It is processing threat. The same systems that would activate if you were being chased, the same deep, ancient wiring, those systems are firing. And when that happens, rational thinking does not lead. Survival instinct leads. You freeze, or you fight. You hold the loss and hope it comes back. Or you revenge trade to make the pain stop. Neither of those responses has anything to do with your strategy. Both of them come directly from a brain trying to protect you from what it perceives as danger. And then there is pattern recognition. Your brain is extraordinarily good at finding patterns. It is one of the things that makes human beings remarkable. But in trading, this gift becomes a liability. Because your brain will find patterns whether they are real or not. You will look at a chart and see confirmation of what you already believe. If you want the trade to work, you will find reasons it will work. If you are afraid, you will find reasons to stay out. This is confirmation bias, and it operates almost entirely below the level of conscious thought. You are not aware you are doing it. That is what makes it so dangerous. Let me give you an analogy that has nothing to do with markets. Imagine you are learning to drive for the very first time. The car is moving. Other cars are moving. There is noise, there is speed, there is input coming from every direction. And your nervous system is overwhelmed. You tense up. You overcorrect. You brake too hard or too late. Not because you do not understand the rules of the road, you studied them. You passed the written test. You know intellectually how driving works. But your body has not yet learned to be calm inside the experience. And until it does, the knowledge is almost useless. That is exactly where most traders are. Intellectually equipped. Emotionally unprepared. Every mistake you make in the markets, every one of them, traces back to an emotional response that overrode your logic. The strategy was not the failure. You followed your fear instead of your plan. The market does not care about your fear. Let me describe what this actually looks like in real trading. Because I want you to recognize yourself here, not to shame you, but because you cannot fix what you cannot see clearly. Here is what happens with the first behavior. You enter a trade, it moves against you. Not by much, a few ticks, maybe a small percentage. And instead of honoring the stop you set before the trade, you move it. You tell yourself the trade just needs more room. You tell yourself the setup is still valid. But if you are completely honest, you know what is actually happening. You cannot accept the loss. The pain of closing that trade and realizing it did not work is more than your nervous system wants to handle in that moment. So you move the stop. And sometimes the trade comes back and you feel vindicated. But what you have actually done is train yourself that moving stops is acceptable. And the one time the market does not come back, and eventually it will not, the loss is catastrophic. This is not a strategy problem. This is loss aversion in real time, wearing the costume of rational thought. Let me describe the second one. You take a loss, a real one, a sharp one, and something shifts inside you. There is anger. There is a need to recover what was taken, and within minutes, sometimes seconds, you are back in another trade, not because the setup is there, not because your criteria have been met, but because sitting with that loss feels intolerable. You need to act. You need to fix it. This is revenge trading, and it is one of the most destructive forces in all of retail trading. The market does not care about your loss. It does not owe you a recovery, but your brain is now operating from a completely different set of priorities than your trading plan. Your brain wants to restore equilibrium, and it will sacrifice your account to do it. Here is what happens with the third behavior. You have a winning trade, it is up, it is moving in your direction, and then it pulls back slightly, just a normal, healthy retracement, and suddenly you are terrified of giving it back. So you close it early, before your target, before your plan said to exit. You take a smaller winner than the setup called for, and then you watch the trade continue to your original target without you. This happens over and over again. Small winners, large losers. And at the end of the month, the math does not work. Even if your win rate is decent. The problem is not the market. It is that you cannot tolerate the uncertainty of staying in a winner. The discomfort of watching an open profit fluctuate is more than you are willing to sit with. Let me describe the fourth one. You miss a trade. You watched it set up. You hesitated. And then it moved without you. And so the next trade, the very next one, you rush in. You do not wait for full confirmation. You do not let the setup fully develop. You just get in because you are afraid of missing again. This is called FOMO, fear of missing out, and it is the market's way of taking money from impatient minds. Every trade you enter before your criteria are fully met is a trade where you have voluntarily reduced your edge. You have let an emotion override a process. Here is what happens with the fifth behavior, and this one is subtle. You have a string of winners. 3, 4, 5 profitable trades in a row. And something shifts. You feel invincible. You increase your position size beyond what your plan allows. You start bending the rules because you feel like you have figured it out. And then the inevitable loss comes, because losses always come, and because your size was too large, it wipes out multiple previous winners in a single trade. Overconfidence is just as destructive as fear. It simply wears a more pleasant disguise. Every single one of these behaviors has the same root. You are letting emotional states make decisions that should be made by a pre-defined process. Now I want to introduce you to something that changed the way I understood trading entirely. And I want you to stay with me here, because this is where most people's thinking has to make a fundamental shift. Trading is a probability game. You already know that. You have heard it. But I do not think you have truly internalized what it means. Because if you had, you would not be doing the things I just described. So let me explain it in a way that goes deeper than the surface. Every single trade you take exists within a distribution of outcomes. Some will win, some will lose. And here's the critical part. You cannot know in advance which category any individual trade falls into. Not with certainty. Not ever. No matter how clean the setup is, no matter how much confluence you have, no matter how many times that pattern has worked before. This trade, right now, in this moment, could be a winner or a loser. And the outcome of this one trade tells you almost nothing meaningful about the quality of your process. Most traders understand this intellectually. But they do not trade as if it is true. They treat every trade as if it is supposed to win. And when it does not, they experience it as a failure of the strategy, of themselves, of the market. They feel betrayed. And that feeling of betrayal is what drives every destructive behavior I described in the previous section. Think about a casino. The casino does not know whether the next hand of blackjack will go in its favor. It does not know whether the next spin of the roulette wheel will produce a profit. Any individual outcome is uncertain. But the casino does not care, because it knows something that most gamblers do not fully grasp. Over a large enough series of events, the edge plays out, the math works. And so the casino simply executes its process, hand after hand, spin after spin, with complete emotional neutrality. It does not chase losses. It does not increase the house edge after a bad night. It does not close the table early because it had a good hour. It just runs the process. Consistently, indefinitely. That is what professional trading looks like. Not exciting, not dramatic, consistent. Now here is where this reframe becomes personal for you. If you truly believed, not intellectually, but at the level of genuine conviction, that your edge plays out over a series of trades, then a single loss would mean nothing to you emotionally. It would simply be one data point in a distribution. Expected, accounted for, irrelevant to your next decision. You would not move the stop, because the loss was already accepted before you entered. You would not revenge trade, because there is nothing to recover. The loss was a normal cost of doing business. You would not cut your winner short, because you would trust the process enough to let it play out. Think about a business owner who runs a retail store. They know with certainty that some inventory will not sell. Some customers will return items. Some months will be slower than others. They do not collapse emotionally when a product does not move. They do not burn the store down after a slow Tuesday. They understand that losses are a built-in cost of operating the business, and they manage those costs as part of a larger, profitable process. Your losses are the cost of doing business, not punishments, not failures, not signals that something is broken. They are the cost, and until you relate to them that way genuinely, not just as a phrase you repeat, you will keep reacting to them the way you have been. When you stop trying to avoid losses and start managing them as a predictable cost, everything changes. Let me paint you two pictures, and I want you to be honest with yourself about which one you recognize. The amateur trader wakes up and checks the markets before anything else. There is an urgency to it, almost an anxiety, as if something important might have happened without them. They sit down at the screen, and they are already scanning for opportunity, already looking for something to do. They have a strategy, technically, but the strategy is more of a loose set of preferences than a defined process. It bends depending on how they feel that morning. If they slept well and feel confident, they take more risk. If yesterday was a losing day, they are either gun-shy or desperate, and both of those states lead to poor decisions. When a trade moves against them, something tightens in their chest. They watch the price with a kind of desperate attention, refreshing, recalculating, hoping. The word hope appears often in their internal dialogue. They hope it comes back. They hope this is just a wick. They hope the news does not push it further. And when it does not come back, when the loss is realized, there is a heaviness that follows them for hours. Sometimes for the rest of the day. They carry the trade long after it is closed. It colors how they see the next setup. It infects their thinking. On a winning day, there is elation, a feeling of clarity, of finally understanding the market. They feel like the fog has lifted, and so they push. They take one more trade than they planned. They size up slightly. They feel entitled to the profits because they feel like they have earned this clarity. And then the market reminds them, as it always does, that clarity is temporary and entitlement is expensive. The professional trader operates in a different world entirely. Not a colder world, a calmer one. They have defined in advance and in writing exactly what constitutes a valid trade, not approximately, exactly. They know the conditions that must be present before they will commit capital. And when those conditions are not present, there is no trade. Not because they lack confidence, but because they respect the process they have built. Discipline for the professional is not a struggle. It is simply the natural expression of someone who has genuinely accepted that the process is the edge. When the professional enters a trade, the emotional work is largely already done. The stop is set and it is final. The target is defined. The position size was determined by risk parameters, not by how strongly they feel about the setup. Once the trade is live, their job becomes almost passive. They manage, they observe, they let the probabilities play out. A loss lands quietly. It was already accepted before the trade was opened. There is no internal negotiation, no bargaining with the market, no hope. Just a clean exit and a move to the next opportunity. The professional is not robotic. They are free. Free from the exhausting cycle of emotional reaction that defines the amateur experience. They have done the internal work to genuinely believe in their edge across a distribution of outcomes. And that belief, real belief, not performed belief, is what makes the calm possible. They are not suppressing emotion. They simply do not experience the same threat response. Because they have fundamentally changed what a loss means to them. The difference between these two traders is not intelligence. It is not access to better information or superior tools. It is not even experience, necessarily, because you can trade for 10 years and still operate like the first trader if you have never addressed the underlying beliefs. The difference is internal. It is always internal. I want to ask you some questions. And I want you to answer them honestly, not to me, but to yourself. Because the truth you tell yourself in private is the only truth that matters here. When you enter a trade, have you fully accepted the loss before you click the button? Not intellectually accepted it. Not told yourself you have accepted it. Actually accepted it, the way you accept that it might rain when you leave the house without an umbrella. A quiet, undramatic acknowledgement that this money is already gone, and what comes back will be determined by the market, not by your hope. When you lose, what happens inside you? Does the day change? Does your next decision change? Does the loss travel with you into the next trade, invisible but present, shaping what you see and what you do? If it does, then you are not yet trading from a place of genuine probability thinking. You are still treating each trade as an event that is supposed to go a certain way, and the market will continue to charge you for that belief. When you follow your plan exactly, enter correctly, manage correctly, exit correctly, and the trade still loses, how do you feel? If the answer is anything other than neutral, then the outcome still has too much power over you. A correct process that produces a loss is not a failure. It is the system working exactly as it should. But if you cannot feel that, if a loss after a perfect execution still stings the same as a loss after a reckless one, then you have not yet separated process from outcome, and that separation is everything. Here is what I want you to understand before you close this video. The market is not the obstacle. You are not the obstacle. Your beliefs are the obstacle. Specifically, the beliefs you hold about what a loss means, about what a trade is supposed to do, about what consistency requires of you. Those beliefs were formed long before you ever opened a trading account. They came from a lifetime of experiences that taught you to avoid pain, to seek certainty, to treat uncertainty as a threat. And they worked in other areas of your life. They kept you safe. But in the markets, they are working against you every single day. Trading will show you who you are with a precision that almost nothing else in life can match. It will find every place where you cannot tolerate uncertainty, every place where you need to be right, every place where fear overrides reason. It will find those places and it will charge you for them, consistently, mercilessly, without apology. But here is the other side of that truth. If you do the work, not the chart work, the internal work, if you genuinely examine your beliefs about risk and loss and certainty, and you rebuild them from the ground up, the market will reflect that too. Consistency is not a strategy you find. It is a state of mind you build. You do not need another setup. You need to become someone who can execute the one you already have.